recording. I think I'll just start out rather than jumping right into OptionVue by mentioning that we do record all of these webinars we do. So maybe I'll share my desktop here. Hopefully you can all see my desktop here. And actually I'm going to start out by going into just into my browser and just pointing out on our website, OptionVue.com, right on our home page. We do have set up each week this webinar schedule that shows what's coming up. So for this week we had Steve Papali do a trading seminar on Monday. Every Wednesday is Steve Lentz with the Inside Wire, and every Wednesday is his Traders Market Huddle. That is a subscription service. And then on Thursdays we do OptionVue Essentials. And this week with me, Jim Graham. You'll also notice that right underneath there's a view full calendar of upcoming events. When you click on it, it brings you to a calendar that shows all of our upcoming webinars or any events that we have. So here's me today. Next Monday is Steve Lentz with our DO Mentor series. If you actually click on the event, down at the bottom it opens up and it'll show right here. Click here to sign up for this webinar. And you can go right in here and register for Steve's webinar for next week right from our website. Now we send a weekly email saying what's coming up, but you could do that as well. Oh, and also looking at our calendar, you'll see we have some special events. For example, on April 16th, Steve Lentz is doing a special presentation to SMB Options Tribe on broken wing butterflies, comparing it against other option strategies to come up with the best expected return. And we're not giving that. Steve's doing it for them, but you could click here and go and register with there to attend that one. You'll also see coming up here on Wednesday, the 24th, Steve Lentz is presenting at the CBOE. At the CBOE, he's doing this webinar, and you can click here and go to the CBOE. With the CBOE, they make you register. So you would have to sign up for their website first to do the CBOE webinar. And then finally, besides this calendar, we have View Archive Recording of Past Events. That brings you to our video archive site. And right in the home, there's all the videos that are available. There's some featured videos that's going to cycle through that are the newest ones. But you also see there's categories like OptionVue Essentials. If you click on that, it will bring you to all of our OptionVue Essential recordings. Discover Options Mentor Series. We'll each have a little brief thing on what they're about. And we also even have some specialized how-to videos about how to do certain things in OptionVue. So I thought I'd point out we have this right on our website. If you ever want to go to it, it's nice and easy. And so that's my advertising for today. You see, I'm just making sure that no one's got a comment. So now let me go ahead and go right into the OptionVue. So you can see my OptionVue here. Let's see, market just closed, or it's basically closed except for some things like SPY, still trading until 3:15. And this is just my quotes display. Today I wanted to kind of talk about a little bit about volatility modeling. Last time I talked all about volatility in OptionVue. But I wanted to go in just a little more depth into the actual volatility model that's used within OptionVue when you're analyzing positions or to get things like the fair value of an option, to let you understand how it works and also show how the different settings that you use can affect it. I'll start out by just going up right in the main, under View in the main menu. Here's where you can set your global defaults. These are defaults that are set so that when you start out a new asset file, for example, it's what will be used. So right now, it has the option pricing model. Yates is just the basic American adjusted option model most people would use. Delta and gamma. The true delta and gamma allows you to take into effect the fact that volatility is on a curve. It should be the most accurate in terms of giving you a delta that correctly predicts how much you'll make or lose when the underlying moves in price. But the one I wanted to point out right here is the skew curves. Skew curves, it says use combined call put skews. So that's one of the settings. I have it unchecked. Now if I went into another one of my files, just choose one like say SPY, and open it up. Most of these settings that you saw on the global defaults are available here in the second button under Model. So the Model button, when you click on that, that gives you these same settings, but for this particular asset only, for SPY. Now notice next to most of these there's a checkbox. If you override one, like I want to use the combined call put skews, a check mark appears in this box. When I click OK, it's always going to save that. It's never going to go back to my default models and ever change this. So from now on, this SPY matrix would use that model whenever it's doing anything, analyzing it, calculating fair values, everything. When I'm here and I'm in the default models, and I want to make sure that this setting, unchecked, is applied to all my existing asset files, I would need to click this A. It's going to go through, check all my asset files and see if there's any that I'm overriding. And if there is, it's going to uncheck it to match my, my global settings. You can see I have a lot of asset files out there. It's going out to check. So all of these settings in the globals have this little A here. So if you ever want to go and make sure that all your asset files are set to a particular setting, you can do that. Click about half done. Next, I'm going to go in and I'll actually explain what this use the combined call put skews means. In the last one I did on volatility in OptionVue, I did a little demonstrations on how a volatility skew curve is drawn. Basically, as for every strike, we measure implied volatility, and we plot it on a point, and you'll get this line of points. And it's a curve. But then what we do is we draw the best fit curve through all those points. So it won't necessarily go through every point. And I think that's easiest to show when in the manual skew. I'll show you a graphic example of exactly what I'm talking about in a moment. So here it went through 406 asset files, and it removed that check mark on 5 of them. So there was 5 that I had been overriding. Now I am not overriding any of them. They're all set to this unchecked. And I will mention, I say unchecked because unchecked is the default that we ship with and that I would suggest using. So let me go into the model. And right up in the first upper corner is a button volatility. In here, we have the variable volatility model. That's this whole top section. You can see it's lightly shaded in a box. Everything in this top half refers to that variable volatility model. The bottom section is the uniform volatility model. That gives you a single number for each stock or index or future that can be used for all the options if you wanted to. It is not a realistic assumption, but there are times when you might want to use it, or that we use these numbers like the current statistical volatility, which is the actual volatility of the SPY right now, 9.7%. And for example, in the shading in the matrix, when we're calculating 1 and 2 standard deviations, it will use this current SV to calculate the log normal distribution of all potential prices. Let me go into the settings, but I'm looking at this variable volatility model. You'll see again here, this use combined call put skews is unchecked. And then you'll see a line that's around the calls, puts, and both. It's around the calls and puts, showing this is what's being used. If I were to check this box, you'll see now the both one is being highlighted. And let me just show in manual skew graph what that means. Let me look at the May options. Here is all the different strikes down here, and this is the measured implied volatility. I can choose set to implied, and you'll see what it does. It exactly goes through each point. It's going to use each individual MIV for each one. But if I choose to set the variable, this is what I mean by drawing the best fit curve. And it will even go out on either side beyond what is actually measured. So this would be, if you're using the variable volatility model for May, this is the volatility skew that would be used. I chose a different month, like June. You can see the measured. Sometimes there are these little unusual little dips and things from one individual reading. But when I set it to variable, you can see how the line is very close most of the way. Here it starts going off. But this is the best fit line curve that can be drawn through all the potential points that we have. I'm just looking at see if I had any comments as I go along. Someone asked, do I recommend we uncheck the use combined calls put skews? And I do. I'm going to go into the reasoning a little bit and a little later. And also, someone asked, the button marked A besides the model listings, are those only on the professional version? And the answer is no, it's in both versions. That's how the Vue default models works. Now let me go back to using the variable. And when I'm using the variable model, we send a default of 1. It's just going to use today's data. Now you could set it to use up to 3 days, and then it's going to run an average, and that's what it's going to use as volatility skew that's going to be used to calculate things like fair value, both current and into the future in the graphic analysis. Now, going back to the measurements, the reason for using, for most assets, 1 day, just today, and for using the unchecking, using not the combined call put skews, using the individual skews for the calls and puts, is that for almost all assets now, even ones that don't trade a lot, the data coming in through the electronic markets, including bid and ask prices, if that option hasn't traded, has been pretty accurate. Everything's computerized, and everything comes through, and you get enough data on virtually all, especially in the equities. But really, the equities, the majority of indexes, and the majority of futures all now have enough data that you don't have to worry so much about first needing to use an average of 3 days. There were times in the past when it was all pit. Now that's going on 15 years ago, 10 to 15 years ago, that a lot of assets would get virtually no quotes other than what was traded. And you might only get data on 6 random strikes across a matrix. And you weren't getting bid and ask reliably on those assets either. And that's why in the past you might have wanted to use that more. Things like a 3-day running average and combining the calls and puts to give you enough data to draw the best possible vol skew curve. That kind of problem with data has almost completely gone away. Certainly on something like the SPY here, you'll see that there's tons of data. Let me see what I got. Got a bid ask and a last on virtually everything, and an MIV being calculated on virtually everything. So that's why I would not use more than 1 day on most things. Bringing in other days when you have minimal data can give you a more accurate reading. But when you already have all the data that you need, bringing in a previous day, for example, the market or news might have caused things to change, and the implied volatilities are maybe considerably higher today than yesterday. And now it makes you look at that fair value, and it's going to be lower than it really should be based on today's market. And then it's going to make you think everything looks a little cheap. I should be buying some options. Let's kind of look at just an at-the-money call in April here. You can see the last is 108. The bid ask is 106, 108. So very tight, mostly a penny or two on the SPY nowadays. The implied volatility being calculated for this at-the-money call is 9.8%. If I come down here, look at the at-the-money put, it's 9.4%. So they're pretty similar. That means right now there is not a big differential between the calls and puts. Now, there is one theoretical reason that people would say that you should use the combined call put skew, and that would be what they call the theory of what is it, parity, that every single option can be there can be a synthetic created, so that you can always arbitrage the difference out of calls and puts. So that in theory there should really be not much or any difference between an at-the-money call and an at-the-money put. And you could do things like reversals, conversions, boxes, which are risk-free arbitrage trades that if the call and put prices went out of line, you would be able to do a risk-free trade with a guaranteed profit. That's a theory, but I've noticed, especially in the equities, and especially at times when things are a little more, market tends to be a little nervous, worrying about maybe a potential of it going down, that actually the puts tend to get more expensive than the calls. I'm not talking like a lot, but 2 to 3%, and it seems to persist for weeks. There's no real edge there. I don't really know what the theoretical reason behind that would be, other than something like an ETF or an index, which an index doesn't exist, but an ETF The only way to truly arbitrage it would be to actually redeem the shares, get all 500 stocks, sell those off, and maybe the cost is just a little higher to do something like that. Now, right now, I don't notice it in the SPY, and we can even go right up in this model and look at the volatility. And we'll just go through and see, like April, 9.5 versus 9.4, 10.1 versus 9.7 in this weekly. I won't look so much at the weeklies. Let me get into the regular months. 11.1 versus 10.8 in May, 12.5 to 11.7. Actually, right now, the calls look like they're just slightly more expensive than the puts. That's almost the opposite than you often see in these equities index ETFs. In September, 13, 13.3, 13.4, 13. You see how they're all very close. And going way out, they're very close. So right here, it really doesn't make that much of a difference. Let's look back at this at the money call in, well, let me choose one with a little more time, like May. It's 233, 236, 11.1 is the MIV. Now the MIV, I talked about this in the last one, but that's the actual implied volatility calculated from this current price. If I double click on it to show the expand window, you can see that here in the MIV, it's like a midpoint implied volatility. There's also a bid IV, which comes right from using this bid price, is 11%. And the ask IV, 11.1, comes right from using this ask price. And the midpoint just gives you a single number that's in the middle of those two. And you'll see every one of them has an MIV until you get kind of far out of the money or deep in the money. Then they're no longer calculated because they reach a point where they're really meaningless. But even though we're not calculating MIV on those individual options, there's still this other field, projected volatility. And projected volatility, this is the numerical display of the actual volatility skew that's being drawn and used. So you can see it's going to be very close all through 13.6 versus 13.6, 14.2 versus 14.2, 11.6, 11.6. They're almost identical. Sometimes they're just slightly off, but then as you get out farther out of the money, there will be a bigger difference. And it's because you're using such small prices. You can see there's virtually no difference in MIV here. But we're using the best fit skew curve, and it's slowly decreasing on the skew curve. And it is this projected volatility, what this number is, that's used to calculate the next parameter I want to point out, the theoretical price. Theoretical price is often also called the fair value. What's a fair value for this option? In this particular one, 233 and 236, and we're saying it's fairly valued at 235. That's what it's worth. So that's right in the range there. I guess we're actually using these prices and this MIV plus how much time's left, and using the option pricing model to work backwards to figure out what price does this option need to be to have this MIV, which is the projected volatility. So you can see this fair value is very useful when you're looking at something, just to give you a reality check. You can see where the bid and ask is. Is it fairly valued? So now we'll look at that at the money. It says it's worth 235. When I go into this policy and I choose to use the combined call put skew, you'll see instead of 11.1, the vol skew curve it's going to use to value these calls is now 11% here. That actually decreased the value of the option by 2 cents. That's what the fair value, the theoretical price, by 2 cents. Just using that combined call put skew. Now, as mentioned in this particular one, that's all it's going to be, a penny or two here or there. It's all pretty fairly valued, and the calls and puts are close together. Maybe I'll try looking at the SPX. Sometimes you see it a little bit more in the index itself. Let's see what that looks like. So I'm looking at the model just to go in, make sure I am using the individual skew curves for the calls and puts. Oh yeah, as we go along here and look though, let's start at the beginning. Got the weeklies. They're pretty close, but notice here in this weekly, the puts are more expensive than the calls. And I see this a lot in indexes, almost a full percentage, right? 9.9 versus 10.9. It's a little more than the weeklies. 10.8 versus 12.5. It's almost a 2% differential there. Another 2% differential in the quarterlies. 2% differential in July. Almost 3% here, 3.5% or so in the December quarterly. So now if we look at this, we use the same format I had, which is using the last bid ask, MIV, the projected volatility, and theoretical price. We can see this at the money 15.95 call in April. Well, I think we need to go a little more out to see the bigger difference. How about May? 9.9 versus 9.7. So at the money, it's not a huge difference, but 11.3 versus 11.7 in the put. Now looking at this, last is 1865. If you're familiar with the SPX, there's usually a very wide bid-ask spread. A lot of that has to do simply with the size of the contract, how much you're controlling. And it tends to usually be about $1. And here we have $18 bid, $19.20 ask. If you haven't traded it, usually you do not have to take the bid and ask in this market. You can usually go in somewhere at the midpoint. So for example, here you should easily be able to get, say, buy that option at, say, 1860, 1870. But you notice we're telling you the fair value is $18.30. So now let me go up into the model again, the volatility, and I'll check this and see what it says. Now there's almost a whole point, and from 1830, it says it's worth 2040. It made a $2 difference in the fair value of this option. So that's one of the reasons why I do suggest using the unchecking the call put skew as long as it's in markets that have enough data. And as I mentioned, there's not really that many markets that I would worry about needing to use it because you have so little data. Okay, let me go and check and see if I got any questions or anything. If you have questions, you can always put them in. I always come back and look at them. I don't see any right now. Let me just go back into the model here in the volatility. Now, when you're in these, I'm going to uncheck this. When you're in these things, you can actually look at some of these months and look at a skew graph. It's going to show you all the readings for the last 3 days. It's going to show you the plotted points and the graph that is drawn. This is not really presented in as nice a way, I think, as we do in the manual skew. The manual skew is only available in the professional edition. So let me go up to the June 13th. So you can kind of see how crazy some of those things look, but those are the readings. So when I set to implied, this is the actual plotted readings by strike of the implied volatility. So along here are the different strikes. This little caret shows the at the money. And here is the implied volatility. You can actually see here, for some reason, there's some big jump. Very little data down here. But now when I choose to set the variable, you can see how we create a nice, smooth vol skew curve that is the best fit curve for all these points. So I hope that's useful to understand the reasoning behind that, and also being able to look in and see what it is. And also to understand that here in the matrix, while we're displaying the MIV for each option, that's most useful for you to look at. If you're going to, for example, look for pricing errors or exceptionally expensive or cheap options, it's much easier to just look at the MIV field and look for something that's out of whack than to actually go through all those prices. It's very difficult to see it in the prices itself, where you can easily pick out a mispriced option using MIV. There don't happen to be any here, and this is a pretty active market anyway. You're not going to see a lot of mispriced options coming in here. But that's how you would do it. But it's also important to understand that that's only used as data points to create this projected volatility skew that's drawn, the best fit curve. And then finally, that volatility is what's used to calculate this fair value. So let me see. I went to volatility, and I made sure I'm unchecked before I do anything else. I think I'll go back to the SPY to use the stock itself. Now, one thing is you can go through with this change. You can change any column temporarily. It's not going to change your format, but temporarily change by right-clicking on it and choosing a parameter. And I'm already showing theoretical price. And I'm also going to show next to it now the percent over undervalued. So this is going to show me that the market price relative to the theoretical price or fair value, how much over or undervalued are these options. We'll start out right at the money here. This is the at the monies. You can see they're all pretty fairly valued, 0, 1%. 1% is essentially fairly valued. You tend to only see a little higher, like something like this one. It might be slightly overvalued, but it's because it's so far out of the money that they're just bidding it at 25 and 27 cents. That is not the type of option that you'd want to use to try to capture like an arbitrage value, like a mispriced option. You would always want to keep looking around pretty much in the money and looking for one that's way under or overvalued. You can really see through all of these. Let me get at the money here. Again, at the monies, minus 2, 3, 4%. These puts here in June. Now let me go again and choose to uncheck it. And you'll see that all goes away. They're no longer 2 or 3% undervalued. They're fairly valued. Because now I'm using the put skew to value the puts and the call skew to value the calls. Let me show you that one more time, like here in June. Notice how these are all 0 and all pretty fairly valued. Go in, and now I'm going to use the combined. And notice how these are all overvalued, like 2%, 3%. These are all undervalued, 3 or 4%. So that's kind of why you really would not want to use the checked. Let me put a trade in here. And I'm going to just buy 5 of these at the money puts and hit analyze. You can see it's just slightly there, but it goes through the 0 line and the dot pretty well. Now let me uncheck it, and I'll hit analyze. The differential is so small, just 2 or 3%. It's hard to tell, but now this line is a little bit lower, this T plus 0 line, and it definitely goes right through the center of that black dot. Before it had been just slightly higher. Of course, the more contracts you're doing, the more noticeable it becomes. So it will affect, especially if you happen to hit one where you really are short, like one of these options that are, although they're way out of the money. Let me see if I can get something even more. If I bought 50 of these, 29% undervalued, I'll try to zoom in. So kind of zoom in on a smaller scale so you can see the differential. Here's the 0 line where if I bought a fairly valued one with no slippage, which is what I'm using as my model, you can see this differential saying as soon as I bought it, I've instantly lost like $350. That all $350 comes from buying what the program considers to be an overvalued option. I don't know how big a difference it would make, but I'll try using the combined. Now it's $450. That's saying I'm losing because it's even more overvalued. So it does make a difference in the accuracy of your projections. I'll move back to using theoretical price here. Let's see, I'm getting near the end here. I got a few more minutes. Let me check my my chat here. Jim Walcott asked about CEV. I haven't talked about CEV yet, but in the model and the volatility, there is a CEV number, and he asks about being able to calculate it manually. There is no easy way to calculate CEV manually. CEV runs on a linear regression that's run across the last 60 days of data, and what it's doing is it's measuring that as the price moved, how much did the entire vol skew curve shift up or down. If the CEV is 1, it means it doesn't move at all. Even as price moves, underlying price moves, the vol skew curve does not shift. If it's below 1, it means that there's an inverse relationship. As price increases, the vol skew curve shifts down. All IVs get lower, and vice versa. As the price drops, the vol skew curve will shift up, and all IVs will go up, meaning all options will be worth more. That's typically where all the stocks and indexes are, below 1. There are commodities like I have to see which ones, but probably things like gold and certainly corn. Something like corn would have a CEV that's greater than 1. Let me just check to make sure I'm right. At 1.068, which means that as the price is moving up, vols move up. The exact opposite of most equities. And as price drops, vols drop. But I'm afraid there is no easy way, and if it's causing problems like in BackTrader because we only use the current CEV, I'm I don't think it should make a big difference anyway, but if it does, you can always turn off the CEV factor. Let me see. Before I finish up here, let me just show one more thing, which is we're talking about theoretical price. And I wanted to point out something I think a lot of people don't use. And most of our customers do a lot of spreads, and they do a lot of more complex trades, things perhaps like butterflies, condors. And that's where these fair values can really come in handy. So when you see what is an option worth, that's kind of nice to just compare it to the current last price, the bid and ask. But where it comes in real handy is if you are, I go out to say May, use the spread window. This spread window, when you click it, it brings up this little window here with a plus or minus sign. You can move it wherever you want. And what you do is you say, I want to buy an option, so use the plus. What you do is you just simply, in the matrix anywhere you want, let's say I'll go a little out of the money. And actually I'll use the shading. Here's where I mentioned we bring in things like the SV to calculate one standard deviation. Here would be one standard deviation right at this line between the pink and the blue. So let me put in a trade. I think I'll just go a little farther in though and say I'll buy or I'll sell 5 of these. Right? You could put it in the trade, or you could simply just select this option and say sell. And then I'll go out a little farther and say, oh, I'll buy this one. So it's a 3-point differential. Sell the May 161 call, buy the May 164 call. And I can click now the show spread window. And it brings up a little expand window that's all about the spread. You can see it shows the May 164, 161 calls. It shows the last sold at a credit of 89 cents. The bid and ask is 92.87 market price, and here's the fair value. It's saying it's worth 94 cents. When I put in one, or let's put in 5 of them in this trade field here, notice it automatically puts it in the trade field here. It can tell me I can, based on my slippage settings and things, I can get it at 90 cents. But now when I'm going out to do an order, I can use this and say, I know it's worth 94 cents. And that's just for the one side. If I was going to turn this into iron condor, I would come down here. 161 is like a couple dollars on the money. So let me go to something like 157 and sell that one. I'll go to the same 3 to 154 and buy that one. And show spread window. Oh, let me get rid of these trades I'd put in already. So now it's showing me I should be able to put this on for a credit 152. Now I can hit analyze behind it and see what it looked like. Get this out of the way so you can see it. But that's a very useful thing to do with fair value, getting the fair value of a spread or a more complex position. All right, well, I think we hit the end here. But if you have any questions, we always leave a room at the end for people to ask questions about anything in the program. It doesn't have to do with anything that we talked about. So if there's any questions, go ahead and ask. We'll just show one more time a couple things. On our website, I mentioned, with OptionVue.com. We got our whole schedule here. And remember, clicking on any of these links, now this is kind of old, but since we're almost done, this is where you would come to register for this class. Close that tab. And I really like this archive videos. That's kind of nice to have that. I like the way we set it up, and it's nice and easy to get through. You can see them in order of new videos, the top videos, which one have been viewed the most. All right, so let me go back to stop sharing. Let's see what I got. Oh, go back to my little slide here. So I am the product manager here. Been here a long time. I think I'm going on like 14 years or 15 years, something like that. And I see someone, look, someone asked how much is the Pro version. Pro version is $12.95 versus $9.95 for the regular edition. And if you have the regular edition, you can always upgrade to the Pro for the $300 difference. See what else I got here. I think that's it. All right. Well, thank you so much for attending, and I hope you continue to come and learn more about OptionVue through these webinars and through the recordings that we have on our website. Thank you very much, and have a good day. Bye-bye.